Hi everyone, so welcome to my video on the time value of money. So this is also a brief introduction, quite relevant to students taking the topic of the Foundation in Financial Management, which is under the ACCA FIA program. It's also relevant to students who are taking their degree level studies on financial management, accounting, and even investments. So let's have a look at time value of money, which is very relevant. Now, so in this short video, I'm going to cover a few things. And I'll try to make sure that it is going to fit maybe 20 minutes. Right? Hopefully this will be informative to you and it helps you to understand what do you mean by the time value of money. So, of course, within this topic, we'll look at how is compounding applied to determine the future value of money, and how do we make use of discounting to determine the present value of money. Following that, we'll discuss a little bit about annuity and how is the concept of annuity relevant, and how do we determine the present value of an annuity, right? Finally, we'll look at the use of time value of money in finance and accounting, but that's a very short introduction. Okay, what is the time value of money? Well, there are many points of view about the time value of money. Some understand it as the value of money today is greater than money in the future. Why? Because some believe that purchasing power of money is constantly being eroded by inflation, right? Well, there is also another point of view where people place greater weight on current consumption than saving for the future, right? So, whichever point of view you're looking at, basically it means that the value of money today is greater than the same amount of money in the future, right? You might be looking at the same amount of money today and in the future, but the value of money today is surely greater for the above reasons, right? So let me just put a number there. So let me rephrase myself again. So simply put, $1 today is greater than $1 in the future because of reasons such as purchasing power is constantly being eroded by inflation, right? There is greater weight placed on consumption today than saving for the future. Now, so why do we need to know the time value of money, right? What do we understand by the time value of money, right? What we understand from the explanation earlier on is that if we have to have a timeline like this today, right, and I'm going to use this term, which is commonly used in finance textbooks, that is t equals to 0. When I use the term t equals 0, it means I'm referring to today, now, right? Now, t equals to 1 refers to 1 period later, or you can understand it as 1 year later. I'm going to have t equals to 2, which means 2 years later, right? So if you understand what I mean by time value of money, it means that the longer that you have to wait and the longer that you hold that $1, you find that that value of that $1 is steadily decreasing, right? Which really means that the value of money today is really worth a lot, right? It's truly worth a lot more than in the future, right? Now, then how do we quantify the value of money today against tomorrow? How do we quantify? It's very simple to say that value of money today is worth more than value of money in the future, but how do we quantify it, right? In finance and accounting, a commonly used method to ascertain value of money today and value of money in the future is that we use this thing known as the compounding formula. The compounding formula can be easily applied with a scientific calculator, right? And this formula simply goes like this. Basically, we say that value of money, or we say future value of money, is equal to the present value of money multiplied by 1 plus I, which is the rate of interest, right, or whatever rate that you're given in the exam, right, So it could be 10%, 3%, whatever it is, to the power of n, which is the number of periods. So I refers to the interest, n refers to the number of periods. And let's use this formula and see how we can use that to determine, in our case, in this example, the future value of a deposit. Let's say, for instance, we have a deposit that is placed in the bank for 1 year, and the interest on this deposit is 10% per annum. Interest earned from this deposit will be compounded annually. Calculate the future value of the deposit at the end of 1 year. Now, how much would the future value be? Using this formula that I've introduced just now, right, we take present value, which is this, the 100, right? Present value refers to any amount today, right? Multiply, in our case, let's apply the formula, multiply by 1 plus I, which is the interest of 10%, but you leave it as 10 instead of 10%, right? Reason being that there is, this is over 100, so there is no necessity to insert any percentages, right? Power 1. With that, input all this into the calculator, you find that this gives you 110, which means that if you were to compare today and 1 year later, the deposit is equivalent to 110 a year later. This 110 that you see here is termed as future value, whereas the 100 that you see here, which is t equals to 0, refers to present value, right? The process of determining this future value from present value, this process is referred to as compounding, right? So when you compound a present value, it means that you're trying to find out how much is it worth in the future, right? So let's look at a more complex example using the same compounding formula. So let's say, for instance, that we have the same $100 deposit placed in the bank today, but now for a 3-year period, the interest will be at 10% per annum and it will be compounded annually. Calculate the future value of the deposit at the end of the 3rd year. Right, so very simple. We apply the formula future value equals to present value multiplied by 1 plus I over 100 to the power of n. In this case, the present value is 100, and then the interest would be 10. And in our case, 10 over 100 in the formula, and power of 3. Now input all that into the calculator, you find that this gives you $133.10. As simple as that. So what it means is that if you were to have this illustrated in a simple timeline, at t equals to 0, which is today, we have 100, but at the end of t equals to 3, you find that you have, in total, how much is that? $133.10. So this 100 is the present value. The 133.1 refers to the future value. Now notice that compared with the earlier example, the future value is greater. Why? Because money is suffering from inflation, right? So the longer that we go into time, or the longer we wait, right, purchasing power of money, or to use money to buy the same goods, basically you have to be spending more money to be able to purchase the same goods as before, right? Or you can just simply say that the 100 today is equivalent to 133 in the future. So what about if this was t equals to 6? Would the future value be greater? Yes, it would be, because as time passes with the greater amount of inflation, it means that you need to have even more money than before in order to have the same amount of purchasing power as the time like today, right? So Now what we're going to do is that we are going to look at what happens if you want to not look at compounding. Compounding is a process where you try to find out how much is a present value worth in the future. Now you can of course reverse that process. That is, if let's say you have a certain amount, according to my example says here that you're going to place a certain amount of deposit in a year's, for a year, and then let's have this illustrated on the timeline, right? So you have no idea what is this deposit amount today, but you know that in a year's time it will be 150, right? But that is a year later. The interest rate is still at 10%, right? So now you're doing the reverse. Now the reverse is known as discounting, right? Discounting means that you want to take the future value and find out how much is it worth in today's terms, or how much is it worth in present terms. So what we can do is that we can refer back to the formula, which is future value equals to present value multiplied by 1 plus I over 100 to the power of n. So in this case, what we're trying to find is the present value. So this is very simple. All you have to do is just shift this part of the fraction of the equation to the left hand side. So this gives you present value multiplied by 1 plus I over 100 to the power of negative n. So this is equals to present value, right? Let's put all this into the formula. So present value of this 150 should be equal to 150 multiplied by 1 plus I, which is 10, over 100 to the power of, in this case, 1, because it's 1 year period, right? Now what you need to do is, don't forget the minus sign, input all that into the calculator. You find that this immediately gives you a result of 136.36, which means that the present value of this 150 is 136.36. So that's how it works, right? Quite simple. So this is discounting. Now let's look at another example, right? So instead of going through this process, often we could use a discount rate table. Discount rate table makes it far more efficient and easier to derive present values. Let's see how we could use this. So like in this case, we use an example which would utilize the discount table, right? So it says here that you're going to put a certain amount of deposit. Now you have no idea how much is it, but you know that this is unknown. The present value is unknown, but fact is, you know that at the end of 4 years, you are going to find that there is a total of $500 in the deposit account, including interest as well as the principal. Question. So now you're going to try to do some discounting, right, to find out what is the present value of this 500. So unlike what we did just now, we could use the formula, or what we can do is that we can now take 500, which is the future value, multiplied by, you can guess, let's refer to the discount table, right? And what we're going to do is that we take period 4, which is 4 years, and period 4 says that at 10%, the discount rate is 0.683. Alright, so it's period 4 and discount factor 10%, the discount rate will be 0.683. So what I'll do is that I'll take 500 multiplied by 0.683. Now notice that how I'm getting my present value is, it takes a lot less effort than earlier on, but this gets the job done and faster. Right, so we find that the present value of this 500 is just 341.5 50. Now you have realized by now that there is some potential problem with using the discount table. That is, there is some rounding, right? If you had used the compounding formula to derive the present value, the answer may differ by some decimal places or even a few dollars, right? But that doesn't matter, because if you use the discount table, you're bound to have some difference from, as compared to using the formula, okay? But regardless, the difference shouldn't be too excessive, right? So what do you do? I mean, if you have to determine present values, well, what we should do to save time is that we have to rely on the discount table. The discount table is a lot more efficient and a lot more easier to use to find present values. Okay, let's go on. Now, next thing which I'd like to explain is the concept of annuity. What is an annuity? An annuity basically refers to a steady stream of cash flows. Now, this steady stream of cash flows can be inflow or outflow, right? Let's have a look at a very simple example. Let's say rental. Okay, apologies for the typo here, right? Let's assume that there is a rental that is payable on a lease asset, and then this lease asset happens to be a vehicle which is leased for 3 years. The rentals of 1,000 per annum are payable. Per annum are payable at the beginning of each year. Now, how much would the present value of the annuity be? Now, this annuity is spanning over a period of 3 years. So it goes like this. From now, T0 to T1, T2, T3. So what happens is that this 1,000 will be payable at the beginning of each year. So if this 1,000 is paid at T0, it would be meant for this following 1 year period. Whereas this 1,000 here will be payable for the period up to T2. And whereas here, this period until T3, amount payable is 1,000. Now, you notice that this 1,000 here is present value because it is at T0. T0 is today, right? Anything today is present value. However, those that are occurring much later on, a year later, right, and 2 years later, these are future values. Now then, with that in mind, how do we determine the present values? Simple. What we can do is that we can take the earlier discount table that you saw, and then use that to derive the discount rate and multiply to determine what is the present value. Let's start with the first one. So, at t equals to 1, I have future value of 1,000. What is the 1,000 in present value terms? Well, simple. What we do is that we take 1,000 multiplied by, okay, let's refer to the discount table, right? At 10%, 1 year, the discount rate would be 0.909. So what we do is that for t equals to 1, then we take 1,000 times 0.909. Now for t equals to 2, then how do we determine the present value of this 1,000? Simple. What we'll do is that we take 1,000 multiplied by, again same thing, t equals to, for the period of 2, the discount rate applicable would be 0.826. Input all that into the calculator. Now, and that will give us the present value of the annuity. So let's work out. So this gives us 1,000 plus the 1,000 times 0.909 plus another 1,000 times 0.826. This gives you in total $2,735. So this is the present value of an annuity, right? So fairly simple to calculate, but could we do it? I mean, you might have also wondered, why did I use 10%? Well, generally if you are taking the FIA exams, usually the assumption is that it's 10%. And this 10% discount rate is normally mentioned, right? Now, of course, if you are taking some other courses, then this may not be 10%. It could be 5%, 6%, whatever it is. But whichever it is, what you need to do is just make sure that you refer to the discount table. Ensure that you refer to whichever percentage that is required. That should give you the correct discount rate. So let's come back to this. Right, fairly simple. Now there is one downside to this method of getting the present value of annuity. That is, what happens if you have more periods, like period 4 until period 20. That makes this method extremely cumbersome and troublesome to apply. Now, is there a shorter way to overcome this problem? Right, we'll see that in a while. Okay, but before I go on to tell you about what's the shorter way of getting the present value of annuity, I'm going to pose you one more question. Then we go to that. Okay, what I'd like to also cover next is what happens if the timing of the cash flows occurs at the end of the year. Now, the example here covers payments occurring at the beginning of each year. But if payments are occurring at the end of each year, then that affects your calculation quite a bit. Why? Because let's go through the illustration. Right. So this is also about rental. Right. Ignore the word deposit. Rental for 3 years. Right. It's 1,000 per year. And it's payable at the end of each year. So let's say t equals to 1. The rental 1,000 paid would be for the first year period. For the second year period, 1,000 equals to 3. This is another 1,000. Right. Now you realize that compared with earlier on, t equals to 0 has no cash flows. Right. But t equals to 1 there is cash flow, but this 1,000 is now future value. What about t equals to 2? This 1,000 is also future value. How about this? This is also future value. Now, like the earlier example, if I wish to know what's the present value of all these rental payments, or to rephrase myself, the present value of this annuity, this steady stream of cash flows, what I need to do, very simple. Right? For t equals to 1, how do we determine the present value? So we take 1,000 multiplied by 0.909, referring to the discount table. What about t equals to 2? We do the same. 1,000 multiplied by 0.826. What about the next one? Right, here we take 1,000 times 0.751. Input all that into the calculator. That gives you the present value of an annuity. So the calculation isn't difficult. I mean, what is important is that you have to assess whether the cash flows are happening at the beginning or is it occurring at the end, right? Because that affects ultimately your calculation of the present value of cash flows. Now, the simpler way to go about it is that we refer to this thing known as an annuity factor table. The annuity factor table cuts short the work of having to find the present value of the cash flows each year, right? How does it do so? Let's look at this example. Using the same example that we saw just now, rental payable on a lease asset, lease for 3 years, and rentals of 1,000 per annum are payable at the end of each year. So what is the present value of this annuity? Very simple. We assume also 10% rate, which I did for the rest of my examples. Now again, it can be 5%, 7%, whatever it is. But for my example, it's 10%. So the cash flows per year is 1,000. We need to find out what's the cash flow per year before you can, use this shorter method of determining the present value. Okay, so it's cash flows per year multiplied by, in this case, it's 3 years, payable end of each year. And what they do, refer to the discount table or the annuity table. Rate is 10%, 3 years, 2.487. Very simple. Times 2.487. This gives you $2,487. do you not find that this is very close to the earlier answer we had? Don't you think that the answers look alike? Yes, they are. Okay. The only difference is that because there is some rounding, that's why the present value may differ by $1 or $2, maybe by a few cents, right? So using the annuity table makes life easy, and of course you are able to complete the calculation of the present value a lot faster. Okay, so I've covered in view the present value of future cash flows, and you find that you could use a discount table to calculate present value. You could use an annuity table to calculate present value. Both are extremely useful. It makes your work easier. Especially if you're taking an exam, right? This concept is fundamental in many other finance subjects because we also use the same method to calculate net present value, right? And also calculate the value of shares and so on. It's relevant in other fields of accounting and finance. Now, the problem with using the time value of money is, or rather the application of the time value of money, is that it can be quite challenging to determine the appropriate discount rate, because depending on what business you are in, the discount rate may vary, right? Of course, in an exam, this rate is normally given, right? And it should be quite easy to derive in the exam. But if it's not so, if we are talking about an actual business, in an actual business, the discount rate usually, is the cost of capital of the business. And this can be quite difficult to calculate, right? Now, on how difficult it is, this will be covered in another video, right? I'll talk more about it, but meantime, that's the topic which I want to cover, time value of money. I hope that this has been informative. Now, what you need to be aware of is make sure you know how to use the discount table and the annuity table. That's all to the topic, right? Okay, thank you for watching and have a great day.